2 years of high prices for everything from groceries to gasoline have left some people struggling to get by until their next payday. To help, some are turning to what are called earned wage access apps, which offer small, short-term loans until the next paycheck. Proponents say they help people with low incomes manage their finances. Critics say they can lead to a cycle of overspending and borrowing, and that the costs aren't always clear. We spoke to people who use these apps.
My name is Sherry Wilkins. I was working as a home health aide and using the app DailyPay. I would need something at the grocery store, trying to get food and trying to do that and this. And I have a pet, so, I have expenses that had to be taken care of immediately.
My name is Anna Branch. Honestly, I was, like most Americans, working paycheck to paycheck, scrolling on the internet, and to me, sounded like a no-brainer. Payday hasn't come. I need some money. They'll give me some money, and then I just have to pay it back.
I probably spent $300 and something a month on transfer fees alone.
Every 2 weeks, I just have to keep borrowing to pay back, borrowing to pay back, and it kind of just turned into one of those cycles.
You become so dependent on that daily money that you don't look at the broader picture of when you need the money to pay your rent or utilities.
Once you start getting into that habit, it kind of feels like a trap and something that's never ending. This is not working the way that y'all said it was going to work. I'm still trying to pay y'all back and stop paying y'all at some point so I can have this money not keep coming out of my account.
According to a financial services research firm, in the 3 years between 2018 and 2020, transactions on these apps went from $3.2 billion to $9.5 billion. Cora Lewis is a business reporter for the Associated Press. Cora, let's get the basics. How do these things work?
So if you're a worker who has an unexpected expense or you're not sure you can make rent that month, you might see an ad for one of these apps on YouTube or Instagram, and all you have to do is download the app and link it to a bank account and agree to whatever the fees might be. And then on payday, the app will debit the amount you borrowed along with any fees or tips you've agreed to.
How are these different from payday loans?
So payday loans typically have very high interest rates, like these loans do themselves, but a payday loan might have a balloon payment down the line. They might sue or send a collector after an unpaid debt, which these apps don't do. So there are some key differences.
The advertising for this is that you're getting an early reach into your paycheck. Is that really what's going on?
The waters are a little muddied right now because some employers do offer earned wage access that's linked directly to your paycheck. So Walmart and Amazon both offer earned wage access without any fees to their employees, which is very different from the direct-to-consumer model. In the direct-to-consumer model, a worker can simply tell the app what their expected wages will be, and that's enough information for these short-term lenders to extend a couple $100s to whoever's using the app. And there's no credit check for these types of loans as well.
Who are the typical users of these apps?
A lot of gig workers and hourly workers in retail and food service use these apps, and a government study found that the average user makes less than $50,000 a year. So it's really people living paycheck to paycheck who are already having trouble meeting expenses who are turning to these apps.
What are some of the pitfalls?
So if you use them for one unexpected expense, if your car has a flat or you just need a couple $100s one time a month, it might be a really good and safe option. But what ends up happening often is an employee will use the app one pay period, and then their paycheck will be much smaller in the following week or 2 weeks. And so to plug that hole, they may turn back to the app again, which leads to a cycle of borrowing as much as once or twice a month, and those fees can really add up. It makes it increasingly difficult to budget, some researchers have found, where instead of having a reliable amount of money every 2 weeks, you have this much smaller paycheck on payday that you then have to compensate for, perhaps by taking out another short-term loan.
And you're talking about the fees and the costs of this. What are the fees?
So the companies will say the fees are comparable to ATM fees, so really just a couple of dollars per use case, and cheaper than overdraft fees, which can be $25 to $36, so maybe cheaper than overdrawing an account. Many apps do ask for monthly subscription fees or tips, which increase the costs. And when you look at them proportionally, the fees are really very high for such small dollar loans.
Is there any federal or state regulation of these, like payday loans are regulated?
So at the state level, Connecticut has passed a law making sure that these apps abide by the state's usury limits for interest. And as a result, at least one company stopped operating there. California is looking at similar laws to cap the fees. And at the federal level, there's an industry-backed bill that would allow them to continue operating as they are now.
Wasn't there a recent opinion from the Consumer Protection Finance Bureau that said these are not loans, and so they do not fall under federal regulation?
So that's part of what's contributing to the regulatory gray area right now, the question of whether these are loans or cash advances. And that will really determine how high the fees can be in the future. So there's a possibility that the Consumer Finance Protection Bureau will review that guidance and decide that these apps should be regulated the same way payday lenders are, which would have a considerable impact on the business as it stands right now.
Someone who's running low on cash before the next payday, they've got bills coming due. What should they consider? What should they think about before using these?
Before downloading any app, make sure you have a sense of what the cost of that loan will be. So that means look for monthly subscription fees, think carefully about linking your bank account. And then when you are asked for fees when it comes to an instant transfer, look for a 1 to 3 day transfer option, which is often cheaper or free. And then keep in mind that when these apps ask for tips, it may sound like they're going towards other vulnerable consumers and low-income people who need to make ends meet. But in fact, many of those tips simply support the company's operations themselves.
Cora Lewis of the Associated Press, thank you very much.
Thank you for having me.